Ladies and gentlemen, new initiatives. We have an exciting speaker who is going to come here and speak to you now. He has come all the way from the New York City. He made it through the snowstorm, through the blizzard, to be here with you today. He's a man who gets things done. He ran the Alexandria Investment Management hedge fund with $2 billion under assets under management, but he also knows technology. He's been involved in funding, creating, and guiding not one, but two technology firms that were providing software for the financial industry. He has his eyes set on a new initiative. He is the man behind our diamond sponsor, Nexyst. And so we welcome from New York City, Mr. Dimitri Sogoloff. Dimitri, please. There you go. Ladies and gentlemen, let's hear it for him.
Thank you. Thanks, guys.
All right. Thank you.
All right. Thank you, Andrew. Okay, we're going to talk about a little boring topic, like how do you invest in digital assets? So we are investors. We work with a lot of other investors to help them understand the products that they actually, where they actually deploy their cash. So what is the problem with the cryptocurrency or digital asset as an asset class for institutions? Why aren't institutions participating? Well, that's because crypto was born in a completely upside down process. If you think about how any new financial product is born, typically it starts with a bank or a financial institution that creates a new financial product. They build infrastructure around it. They build custody, settlement, margin requirements, trading, all of that stuff. And then they sell it to whom? To institutions. That's how products move. Ultimately, down the road, some products end up with retail, where you have fractionalization, where you have a little bit more liquidity and things like this. This is how most financial products, actually all financial products, are developed. We in crypto have gone completely the opposite way. So this is a crypto product that went into retail originally. There was no real infrastructure to speak of. There was fractionalization, marginal liquidity, and now sitting between the institutional participation and the product is this infrastructure thing. So we all talk about infrastructure. What is it? Can we feel and touch it? And can we really put some numbers on this barrier that is infrastructure? So I'm going to do some math, and I'm sure most of you are very comfortable with math. So in numbers, how do we define this infrastructural barrier? So as most of you know, investment decisions are made by sophisticated investors on a risk-adjusted basis. What that means is that you have to ask yourself, how much return are you going to get for 1 unit of risk? So returns are easy, that's fine. What is risk? Most of us substitute volatility or the market risk of that asset for risk in this equation. In fact, that's not quite accurate. Risk is not just the market risk, not just volatility, it's also operational risk. It's the risk of your investment blowing up for no reason that's related to the asset class itself. Typically, we're looking for at least a 1-to-1 ratio. We're looking to pay 1 unit of risk to get at least 1 unit of return, or better. So if we take BTC as a benchmark, as a proxy for this asset class, and if we look at the period of 2016 to 2017, this is the return, 138% average annual return, with a vol of 62%. That gives me 75% of operational risk that I can live with before I hit that 1-to-1 ratio. From your statistics 101, that means that I can afford for 32% of my investments to completely fail and blow up for no reason that's related to the asset class itself. So this is somebody hacks into the exchange, I lose my tokens. A guy goes to India with a private key and decides to die there, and the tokens are lost. None of this is related to the investment decision, and back then I could afford 32%, complete loss. Therefore, people really weren't focused that much on infrastructure back then. Now, if we take the same BTC and extend this period to today, a little bit of a different picture. Now 67% average annualized return with 64% volatility. That gives me the allowable operational risk of just under 4%, which means less than 2% of my investments can fail for that infrastructural or operational reason. That means I have to make 50 investments and let one fail before I can actually deploy my cash into this asset class. It's part of the reason why institutions can't quite yet get to where they need to be. So for any sophisticated investor, what is keeping them away from the asset class right now? You have kind of four major problems. You have a large number of very small managers. So over 500 managers in the space with average assets of less than $20 million. Very little information available, very short history. With that, you really cannot make an intelligent investment decision. Survivability. If a manager is down 50% last year, he has to double his return before he starts making his fees, before he starts making performance fees. That means how long is it going to take him to make that 100% back, and where is he going to get the money to pay the bills in the meantime? So is he survivable for the next 2 to 3 years that it's likely going to take him to make that 100% back? And why would I invest in a manager that is likely not going to survive? Specialized due diligence is another one. We just don't know what we don't know. And many investors right now, many sophisticated institutional investors don't know what questions to ask. And therefore, they can't make an investment because they just don't understand the due diligence process. And of course, the operational risk that plenty of people today and tomorrow will be talking about, all of the usual suspects: custody, governance, service partners, regulatory compliance issues, fork management. The list goes on and on. All of this is being solved right now, so we're a lot more optimistic about this part of the equation, but the rest of it is still out there. So why should we care? Why should we as investors, as family offices, as institutions who are actively looking to allocate to the space, why should we care right now? There are two main reasons. We're looking at massively asymmetric returns. Just taking BTC as a proxy again, today it's, well, actually it's not 3,800, it's about 3,700 or so. We believe that in the next 12 to 24 months, there are equal chances for BTC to hit 2,000 as it does to hit 20,000. So as you can see, the expected return is massively in favor of this asset class. It's highly asymmetric. If you look at more active strategies, so active traders take up 3% of the market cap right now. In more mature traditional asset classes, that number is 20%. So you have this delta between 3% and 20% that is pure inefficiency. The market is not going to get efficiently priced until that number gets much closer to 20%. In crypto lending, the story is even worse, or I guess it's better for us, the investors. Less than 1% of funds are actively pursuing a lending strategy. In more mature markets, 15% is roughly where these markets become efficient. So you have a lot of room in between where there is a pretty massive inefficiency. And of course, VCs, we think, and we all know, potential returns are much higher compared to more regular traditional VC funds. Of course, risks are higher as well, but we still think that the returns are going to far outweigh the higher risks. And time to exits are going to be shorter, because these businesses are dynamic, they are developing much faster, and likely they're going to be taken out much faster than pretty much anything out there. So that's number one. Number two is correlation. We buy new stuff because it helps us diversify our existing portfolio. So right now, BTC to S&P 500 is about 0.2, and actually it's falling. So that's pretty good. More importantly, There was this survey done at the end of last year among institutional investors. 72% of them felt that the value of cryptos will go up when there is a major recession. And that's a pretty important metrics, because now investors have themselves another hedge against the downturn in the market. How does one get involved in the asset class as a passive investor? Well, there are really 4 ways to do this. You can go complete beta, which is essentially an index product, right? So there are multiple indices out there. They have different flavors: equal weight, market cap, volatility adjusted, target volatility indices. We have a personal preference for target risk or target volatility indices, but that's just our personal preference. There is active trading with all sorts of different flavors in there. There is lending, either fiat lending to crypto players or crypto lending. And of course, there is venture cap, which is kind of split into 2 parts, either infrastructure investments or DApp, DApps investments. So you have to decide on the asset allocation first. Where do you want to be? There are different betas, from 100% beta on the index side to negative or 0 beta on the right side of your screen. And there are different liquidity constraints as well, from daily to much, much longer. So this is where the investment decision needs to start. When will the institutions come, and what needs to happen for them to start really participating? Well, all of these things need to happen. Custody, trading services, margins, lending, financial instruments around us, like derivatives and options. Regulatory clarity needs to be there. It's all moving in the right direction. And so here's our timeline. Here's how we envision this market. Today, we have early adopters. We have Yale University. We have Virginia Fairfax County Pension Plan that just made an investment. We have CIC. We have a small handful of sophisticated, large institutional investors who are making that first step. Next year, more of the same types of institutions, the same people that have invested early in hedge funds 20 and 30 years ago, some of whom were my clients in early 90s, endowments and sovereign wealth funds are going to start slowly coming in. By 21, 22, so 3 years down the road, possibly 4 years down the road, you're going to have a much more, much bigger acceptance. Here's what this means to the industry. A 1% average allocation from the institutional world to the asset class is $300 billion. You can do the math and figure out what that does to the prices. But nobody invests less than 1% of their portfolio. This is, I don't know how many people have seen this memo from Cambridge Associates. Cambridge Associates is one of the biggest, most conservative and well-respected investment consultants, advising about $300 billion of institutional clients. And this is a massive message that came out in their memo to clients about 2 weeks ago. We believe that it's worthwhile for investors to begin exploring this area today with an eye towards the long term. These investments entail a high degree of risk, but some may very well upend the digital world. What this means in plain English is Cambridge is massively bullish. They cannot say this in the public memo, but that means that every analyst inside Cambridge is now talking to their clients and essentially advising them to really take a much closer look. That means in the next 3 to 6 months, every investment committee is going to be discussing their policy towards this digital asset class going forward. What do we do as investors in the meantime while all of this is happening and while we think the market is going to expand quite significantly in the next 2 to 3 years with these institutions coming in? We have to decide on the long-term asset allocation, those 4 buckets. Where do we want to be? Liquid, 100% beta, less liquid, positive beta, negative beta, high-level decision. Do not time the market. This is not the market to be timed. You have to make your long-term asset allocation decision and stick with it. You have to get the right expertise. Whether it's from Nexyst, whether it's from anyone else, you have to get the right help, the right expertise that understands where to look and what questions to ask. Patience. That's it. It's a new asset class. It requires patience, and patience will be very significantly rewarded. I'm going to stop here. I think I don't have time for questions. Feel free to catch me outside. This is a link to investors who want to learn a little bit more about what we are doing in trying to bring the digital asset class in a more institutional, more transparent, and more accessible format to every family office and to every high net worth individual investor out there. Thank you very much.
Whoa. Thank you so much, Dimitri. You've come a long way to be here and share this with us. Thank you very much. Dimitri Sogoloff from Nexyst, diamond sponsor of Block 020, supporting you all being here today. Thank you.